Hello everyone and welcome back to Module 8. In this module we're going to be talking about how to use self-directed retirement funds. So let's dive in. Now just like in every module that we've done so far, I got to give you the disclosure. I am not a licensed attorney, accountant, financial advisor, broker, agent of any kind. I don't have any licensing. This is not to be considered as counsel. These are just strategies that I have used that I've been very successful with that I'd like to share with you. So make sure that you reach out to your accountants and attorneys and all those other things to help you with specific transactions that you're doing as you apply these strategies. Now let's dive in. Let's talk about self-directed retirement funds, or as I like to call them, SDRFs. That's the acronym SDRF. So let's talk about the rules. With a 401k, you can borrow up to 50%, but not more than $50,000. So if you've got $20,000 in your 401k, you can borrow $10,000. If you got $50,000 in your 401k, you can borrow $25,000. If you got $100,000, you can borrow $50,000. But if you've got $500,000 in your 401k, you can still only borrow $50,000 because that's the cap. With an IRA, you can't borrow money from your own, but you can borrow money from a non-prohibited party. Now let's talk about that for just a second. A non-prohibited party is someone that you are not directly related to. So it can't be your children, it can't be your spouse, it can't be your mom or dad or your grandma or grandpa. However, it can be brothers and sisters. It can be in-laws. It basically, in your family tree, it can't be vertical. It has to be out sideways, right? So for more information, you're going to want to chat with your attorney or the custodian of your self-directed retirement fund. Usually your attorney is a great place to start there. So make sure that before you go start raising money from people that have IRAs and 401ks that you understand whether or not that party is prohibited. There are also other hidden things that I may not have covered in that description. So in every specific scenario, you want to chat with your attorney and with your self-directed retirement custodian before you initiate those transactions, just to make sure that you're following the law. Now, a self-directed retirement fund, you can invest in anything allowed by law. So with a normal 401k or IRA, we talked about borrowing the money outside of those funds, but now let's talk about the self-directed retirement fund. And this is cool because it allows you to use the real estate as the actual investment that your retirement account is investing in. So, for example, when you borrow money out of your 401k, that no longer is, those funds aren't considered part of your 401k while you've got that loan out. So you can go and use that money however you want to, but you have those limitations that we just talked about. With a self-directed retirement fund, technically the money is still inside of that retirement account. But rather than investing that money in stocks or in mutual funds or in, whatever other things, you can invest that in your investment real estate. You can buy rentals with it, you can buy fix and flips with it, etc. But there are some laws and some rules that we need to go over with that. And there are some restrictions that we should talk about here. With self-directed retirement funds, you are not allowed to buy antiques, collectibles, coins, which, by the way, collectibles includes wine because people tend to drink their retirement, right? You can't buy personal use real estate. So that's one that's really applicable to what we're talking about now. When you use your self-directed retirement account to purchase real estate, you cannot live in the house, you can't work on the house, you can't even mow the lawn, you can't be the property manager, you can't do anything that directly benefits you personally because it's intended to be part of your retirement fund. So keep that in mind. Personal use real estate is a no-no. If you're going to use your self-directed retirement fund, remember that you can't do any of the work. You have to push all of that out. But as you've been watching these modules, I think you've caught on to the fact that I don't like doing the work anyway, because that's not what investors do. Investors invest, right? Contractors do the work. Property managers do the work. My work is I go find properties and figure out how to fund them, right? And then collect the cash flow. So and that should be your strategy as well. That's the recommended way to do it. But that is required by law if you're going to use a self-directed retirement fund. You also cannot purchase life insurance or shares of an S corp in a self-directed retirement fund. So keep that in mind as we jump in here. So steps for the private lender. If you're going to use someone else's self-directed retirement fund, here are the steps to be able to start using that. Step number 1 is open a self-directed retirement account with a licensed custodian. Consider an IRA or a 401k LLC for multiple loans. So there are a few restrictions, I guess is the best word for it. There are a few restrictions on how you can use those funds and how the custodian has to be involved. I like to open the self-directed retirement account and then start what's called an IRA LLC or a 401k LLC, which is basically just a normal LLC that's designated to be owned by a 401k or an IRA. And the reason I love that is because when you have an IRA LLC or a 401k LLC in your retirement account, it gives you checkbook control. So you don't have to hit up your custodian every time you need money. You have control of the checkbook. You can write those checks, and if you're using someone else's self-directed retirement money and structuring them as an equity partner, or structuring their self-directed retirement fund as your equity partner, then they have the ability just to stroke you checks whenever you need them. They don't have to reach out to their custodian every time. So step 2 is to vest the note for the loan or property. That just simply means making sure that the money that they lend you is secured properly. That's done usually with a notice of interest that's filed with your title company. And we don't need to go into too much detail on that, because all you need to do is just when you're transacting the property at the title company, just tell your title officer, I need a notice of interest for this person's self-directed retirement fund. They'll know exactly what you're talking about. That just is a little note that's recorded on title. When the recording is done, after you purchase the property, the recording is the process that puts that property into your name legally. It's a little note on that title that says, hey, before this property is allowed to be sold, we need to make sure that so-and-so's self-directed retirement fund, that their notice of interest is satisfied before any funds are distributed to the seller. Okay, so it just protects the money that you're borrowing, which is always a good idea, and in many cases is required by law. Sign agreements which authorize the custodian to release the funds is step 3. Step 4 is, and your custodian will provide those to you. So let's talk about what a custodian is for a second. So when you're, when you get a 401k or an IRA from the job that you work at, they usually have a fund manager that manages that for you. Well, a custodian acts very much in the same way with a self-directed retirement fund. Now, this is a good time to bring up a side note. With 401ks that were set up by companies that you worked for in the past, you cannot roll those over into self-directed retirement funds if you still work for that company. However, if you have left that company, whether you quit or you got laid off or fired or whatever the case might be, you still have that 401k. It's just floating out there. It's called an inactive 401k or IRA now. And you can roll that over into a self-directed fund and start using those funds to invest in real estate. And you can educate other people on being able to do that as well. When it comes to fund managers, the custodian really is kind of the gatekeeper to make sure that you're following the rules and following the laws as you use those retirement funds for your investing purposes. Step number 4 is execute the real estate transaction. Go ahead and close on it. Go to the title company, sign the documents, wire the money, all of those things. Send copies of the security agreements to the custodian. So copies of the notice of interest that you have the title company put on that title, securing the retirement funds. Send that to the custodian so they can have it on record. And then coordinate with the loan servicing company to send payments to the lender. So that's however you've got that set up. Again, I really like using a 401k or IRA LLC because then that gives me the ability just to wire that money into the transaction. So, and over to the title company. So whatever that looks like, your custodian can provide you with more information, and that does vary based on what company you use as your custodian. So you're going to need to coordinate with them to make sure that that money gets transferred to the title company so that you can execute that transaction. So let's talk about steps for the equity partner. So that's opening a self-directed retirement account with a licensed custodian or IRA 401k LLC. So your equity partner that's going to use their retirement funds, this is what they need to do. They need to secure a joint venture agreement or an LLC partnership. So their IRA LLC or their 401k LLC may own 50% or 33% of another LLC that you guys are using to execute this transaction. So you can layer those entities to make this transaction work. Step number 3 is release the funds. With an IRA or 401k LLC, you have checkbook control. Again, I mentioned that. That's why I love IRA and 401k LLCs. Execute the real estate transaction. So go to the title company, close on it, right? Send copies of the security agreement to the custodian. Usually, again, that's a notice of interest, which we've already talked about. Now, I want to talk about how to pitch funds, because here's the thing. Not a lot of people have hundreds of thousands of dollars just laying around, right? I mean, who has 200 grand sitting in their bank account waiting for you to go talk to them so that you guys can go do a fix and flip together? However, there's like $28 trillion in retirement accounts in this country. And so there's a lot of people. There's only 400 million people who live here. So there's a lot of people who have a lot of money in their retirement accounts, right? And we can access that by helping educate individuals that they don't have to leave their money in their 401k or IRA indexed in mutual funds. They can invest that in real estate, and more specifically, they can put that into real estate deals that you bring to them. So here's my 2-question pitch that I use every time. Did you know that you could use your retirement account to buy real estate? A lot of people don't know that. In fact, I told that to my grandpa one time, and he thought I was breaking the law, right? Because he had no idea. But legally, you can use your retirement account to invest in real estate. There are laws around that. You need to familiarize yourself with those. We talked about the restrictions around that. You can't do the work yourself. You can't live in it. You can't even maintain the property. You can't mow the lawn. You can't manage tenants. You have to hire all of that stuff out. But your retirement account can own interest in real estate as long as you follow those rules. So regardless of how they answer that first question, whether they say, yeah, I did know that, or no, I didn't know that, the second question is the same. If I could show you how to potentially get more profit backed by real estate, would you partner with me on my next deal? Now, that's not hard to show. If you go back to the previous module, the debt equity blend, it's really easy to show people how they're going to make considerably more profit by putting money into deals that you structure versus keeping that money in mutual funds or in the stock market. So make sure that you are transparent about the risks. Talk about the exit strategies with them. If it comes to that. Always be upfront and transparent about those things. That's going to protect you legally. It's also going to protect your relationship. But if I could show you how to potentially get more profit backed by real estate, would you partner with me on my next deal? So they're looking at this question and they're thinking, okay, he's telling me I can make a higher rate of return, and he's telling me that it's safer because it's backed by real estate. Okay, I'm listening. I mean, who's not going to listen to that, right? So questions to be prepared for as you're raising those funds. How is my investment secured? Well, the answer is a notice of interest and a joint venture agreement or LLC based on what your attorney recommends. Who pays for the company setup costs? The answer is the project. You're not going to pay for them out of pocket. Your equity partner's not going to pay for them out of pocket. The self-directed retirement account's not going to pay for them out of pocket. It will come from the funds that go into the pot that pays for the project, but that's one of the costs as you're setting up these different entities that you need to go do this deal. That should be one of the line items for costs associated with doing the actual project. So the project will absorb that as a cost line item that will be deducted before you calculate profit on the back end. What is your track record? Well, if you've got a good track record, share it, right? If this is your first deal, be transparent about that. It's never a good thing to lie because that always comes out and comes back to bite you in the long run, right? Also, in the case of using other people's money, lying is fraud, and that's illegal. So you want to avoid that. But share with them your track record. What are the risks? And by the way, with track record, if you don't have a track record, which may be the case for a lot of you, you might just be starting out. That's okay. Don't be ashamed of that, right? What you are able to pitch them on is the knowledge that you've gained by becoming an educated investor. And if you can walk them through every step of, for example, the debt equity blend, and show them how we're going to be protected at every turn and at every corner, and regardless of what direction this goes, we're still going to protect your money, then they're going to feel a lot more comfortable about that, even if your track record is fairly thin or non-existent. What are the risks? Always disclose all the risks. They could still lose money. Even with the debt equity blend, you could still lose money. There is that risk. It just has a lower risk than a lot of other things out there. What happens if we can't sell the property? Talk about the alternate exit strategies like renting it out, and any other exit strategies you might have. How long will my money be committed? Well, that's going to be subjective. You're going to have a conversation with them about that. How will my profit be paid back to me? In the form of a wire usually is the best way to do it. How will my capital be returned? In the form of a wire, right? So helpful tips as you're raising these self-directed retirement funds. Be confident. If you go in all skittish and nervous and scared, they're going to pick up on that, and that's going to make them skittish and nervous and scared, and they're not going to want to put their money into that deal. So go in with confidence, right? Be educated. The more you can show someone exactly how a deal is going to work, and and that you've covered all contingencies with exit strategies and alternate plans, the better they're going to feel about it. So the more you know, the more you're going to be able to share and educate. So be educated. Take the time. If you're setting up your real estate investment business, take the time to get educated. Spend the money to get educated. It's worth it in the long run, and it's going to open a lot more doors to you. Obtain buy-in. So get their commitment. One of my background is in sales. Before I became a real estate investor, I had several different sales jobs, and so a lot of those skills have carried over for me into real estate investing. And one of those skills is assume the close. As you're having the conversation with these individuals, just assume that they're going to do it. That's going to come through in your language, and that's going to kind of put their frame of mind in, oh yeah, I guess I am doing this, right? So assuming the close kind of gives it that extra oomph to get them over the top. Minimize risk. Always properly draft your documents. Always, always, always use an attorney if you're using retirement funds for a deal. Use entities for title. So what I mean by that is use LLCs. Use partnerships, like actually legally structured partnerships. Use whatever your attorney recommends. Use that type of entity. Never structure an entity in your personal name, never structure a real estate investment deal in your personal name, because that opens you up to liability, both legal and civil liability. Have a clear exit strategy with alternate exit strategies, and discuss those and how you're going to minimize that risk because of the exit strategies that you could use in the case of the market changing, or spending too much, or a contractor ruining things for you. So have those exit strategies ready to go as you go into the pitch. Easily describe the system. The more simply you can describe your plan, the easier it will be for other people to understand what it is you're going to do. The more complicated you make it, the less likely they are to invest, because they may not understand it. The more simple terms you can put things in, the more confident they're going to be that they understand it, and they're going to be more likely to jump in. Provide referrals. If you've done deals in the past, or if you've been a part of deals in the past, as a partner or as an operations manager, provide referrals to the people that you worked with, so that these people who you're raising funds from can kind of check up on you, right? And that's okay. Let them do that. Show your track record. If you got a track record, show it. Brag about it, right? It's only going to help you. So that wraps up the self-directed retirement fund module. Hopefully you guys gained an understanding in this module of how to go and pitch money. I shared with you the scripts on how I use the questions and the verbiage that I use to talk to people who have money in their retirement accounts. and educate them on how to set those funds up in self-directed retirement funds so that we can go do real estate together. So our next module is how to become a lender yourself. Maybe you have a retirement account or a home equity line of credit or some cash laying around, and you want to become a lender yourself in real estate investing. That's what we're going to talk about in Module 9, so stay tuned. I'll see you over there.